Hey, everybody. Welcome, welcome, welcome. Happy Wednesday. I am glad to be back down on the floor. Yes, back in the live Cboe S&P 500 options trading pit. And this is just a blast from the past, guys. I'm a little taken aback right now because I'm looking up in the gallery right here, and there happens to be a visitor up there. And even though I probably haven't seen him in 20 some odd years and he has aged considerably, which, listen, we all do. I get it. We all do. That's a former trader who we never saw eye to eye. I'd like to talk to him actually. His badge, his acronym was MRJ. Hey Mike, how do I get my chat enabled here? Hang on with me, everybody. I need my. Okay, there we go. There we go. There we go. I just did it. All right. So here we are. What a big turn of events in the market over the last hour and a half or so. I don't know. It was about what 10 o'clock or so this morning, Chicago time, that we saw the markets on their lows of the day. S&P's down about 30 or so, and now we're up, 9 points, 10 points. So some of the volatility has eased. Maybe some of the concern over Google's miss, AMD's miss has eased. Can everybody hear and see me okay? Because, oh, sound is doing great. Yes. What are your options? The trading den. Come on. I want everybody here, everybody, absolutely everybody to smash. Okay. And in fact, guys, look what I'm going to do here. Okay. We're going to start off with this, and I'm not doing anything. I'm not doing anything before you guys do this. Okay. I don't like asking for much. I know I have done this before. On your YouTube stream, right there, just below your video, there's going to be a subscribe button that has that little alarm bell next to it. And there is going to be a thumbs up or down. Obviously, we don't want the thumbs down. Hit that like, smash it. Smash it. All right, awesome. So before we get into the topic of the day, which is the short strike, okay, I want to just talk about a little of what's actually happening here live in the markets. Okay, so right to my, again, my 11 o'clock or so, I'm pointing over here is the VIX pit. Okay, as many of you know that are in the option volatility room, one of a very close friend of mine is the biggest broker in there. And so I am constantly getting updates on what is going on, what the paper flow is like, not just looking, on Thinkorswim or whatever to see what the paper is, but what the actual paper flow is. And those of you that have heard me know that for about the last week or so, and it has continued today, there is not only a lot of buying in upside March VIX calls, but many, many positions, size positions that there were in February have rolled out to March. In fact, let me read you. Let me read you one of the big trades today. Here we go. So if we look, okay, if we look, February 40 calls, and let's actually bring those up on the screen here. All right. February 40 calls. Okay. If you look right here, everybody, there were 180,000 open interest. Okay. Today, just today, and I guarantee you this is just the start, you can see there's 48,500 of those that have traded today. Now, someone may just look at that, not knowing what that trade was all about, because it flashes up on their scanner and say, oh man, 48,000 of these Feb 40 calls and the VIX just went up. People are buying these calls. That's not what happened. This is a massive roll. So the owners of those Feb 40 calls rolled out opening position, and you can see it right here. It's the exact same quantity to the March 45 calls. Okay, does everybody see that? Everybody see that live here? It's the exact same quantity. Okay, so those of you that use scanners, and it's great that you do, to see unusual option activity, or something may blow up on one of your scanners, like someone mentioned some calls that were being bought in Cisco today. You always have to take a deeper dive into what that trade might be. Okay, so this was someone, and again, maybe it's the 50-cent guy, who knows. This was someone taking off their Fed position and rolling those options out to have those upside VIX calls out a month later. So this started about a week ago. And as I explained earlier in the OpVol room, that's the reason why we rolled our February position out to March last week. When I first started hearing that from my buddy over here in the pit of what was going on, that's why I wanted to roll that out. Does that make sense? And thank you, Gilbert, for doing that. John, Frank, okay, Pat, Robert, everybody, thank you for doing that. Does that make sense to everybody? Now, we're going to talk about the short strike, something we talk about and preach about every day. And many of you may, know the answer to where do we want a position to go. The answer is always the short strike. But why? Why do we always want it to go to the short strike? What's significant about the short strike? Right? We trade spreads. Sometimes we have a combination of options, if it's a butterfly, an iron condor, whatever it might be. But in 99% of the cases, maybe 98% of the cases, we will have a short strike and a long strike, or multiple short strikes and multiple long strikes. Okay, in the rare event that we would just put on a position with either a long individual option or a spread position where both options are long, like a strangle or a straddle, we would want the stock to move as far away from those strikes as possible. But what is so significant about the short strike? Yes, as Chris just said, if we get to the short strike at expiration, we keep all of that premium. And then, as Robert just said, we sell that strike to help finance what we are buying. Okay? Those of you that tuned in to my spot on Schwab Network this morning, or that looked at the signal we put out in QCOM this morning, it was a strangle swap, or what's known as a double diagonal. Okay, what did we do? We sold this week 155 put, 190 call, and bought the same ones next week. So you can look at that in two ways. You can look at it like Robert just said. Okay, we bought next week's options and financed it by selling this week's options. Okay, now what we want ideally in a perfect world to happen, and we're going to look at some live examples here, is for the stock to move to one of those short strikes this week. We want the value of those short options to collapse while the value of our long options hold their value. Okay, let me blow this up here a little bit because that might be a little bit, whoops. There we are, trying to get that all on the screen here. Maybe one more. Okay, there we go. Okay. So, as I have here, any Did I say any? Any, and I mean any spread. Okay. Any spread position that you have will max out at expiration at the short strike. Verticals, butterflies, iron condors, a short position like a short strangle or a short straddle, a calendar spread, a diagonal spread, you name it. Robert, I forget the name of one of the names you gave to one of our positions one time. It was like the iron blue moose or something. I forget exactly what it is, but you put on a position, your position will max out at the short strike. Aluminum buzzard. There we go. That should have been the word of the day today. Aluminum buzzard or buzzard. Yes. Okay. Option strategies have weird names to them. Condors and the like Christmas trees. Just remember, as we always say, we want a stock to move to the short strike. Now let's take a look. Let's actually take a look at some live examples now. Okay. Um, Let me pick someone here. Jake Jacobson. Can you hear me? Jake, I know you're in the house. Can you hear me? Yeah, I don't like that guy. Sorry, folks. I like most people. I don't like that guy. He was a real scumbag of a trader. He was the kind of guy that, a broker would come in, ask for a market, right? And I would give the market, 182, meaning, I'll buy it at 180 and I'll sell it at 2, and the broker would say sold at 180, and then this chump would say 180 bid. Just would always glom on, would always ride the coattails of other people. Yeah, I'm not a big fan. Anyway, okay, Jake, give me a stock you want to look at. Does not matter what it is. We're going to go through a live example of how and why something would max out. And you know what? Let's actually do something, Jake. Whatever stock that you give me to look at, we're not even just going to look at a vertical. We'll do something like an iron condor or a butterfly so I can explain exactly why. FedEx, wonderful. Let's look at it. Okay. All right. So let's say we're bullish in FedEx, okay, which we actually are. We have a position on. Okay. Right now, okay, how would we determine which short strike we want to trade? How do we know which of the options in our position are the long ones and which are the short ones? What do we base that on? Okay, because we can't just close our eyes and say, yeah, it's this FedEx right now. I'm going to sell the 250 and buy something else against it or whatever it might be. There you go. Thank you, Jake. It is the expected move. Bobby, there you go. It is the expected move. I know this might be redundant. Dart sometimes works, Jake. I know this might be redundant for some of you, but I'm doing this because I can't impress enough how important this is. So right now, FedEx is trading 249. Let's just look at 250 here. Okay, so I've just circled the 250 strike that expires Feb 21. I've circled the call, the put. What is our expected move? Magic 8 Ball is always the go-to, Robert. You know that. Can't even find them anywhere in stores. You can order them online on Amazon if anybody ever wants one. Those were fun, especially when you were like, 12, 13 years old and you were at your, maybe one of your first boy girl parties or something, right? And you're shaking that magic ball. Does Mary over there, does she, I'm not going there. Anyway, the expected move is, 10 or 11 bucks. Okay. So let's say we're bullish. We're going to target 260. Now, when we talk about targeting a price based on the expected move, when we say target, that's our short. That's our short. So we build our position based around the short strike. We know the option that we want to sell. Okay. So what we do then is we back into which options are we going to buy? How do we do that? Why do we do that? Well, we do it based on what gives us the best reward to risk. Okay. What gives us the best reward to risk? So when we talk about expected move, when we talk about that target, that is going to be the bullseye of our short strike. And we construct our position around that. Okay. Now, let's say we put on this position here, and I'm intentionally going to put on a butterfly here. Okay. So I can really explain and show why short strike is where we want to go. Okay. So here is a position. Again, it truly doesn't matter. I mean, it does matter in terms of reward to risk, but really doesn't matter, again, what the kind of position is. Your max value at expiration will always be at your short strike. So if we are at 260 here at expiration, not today, not tomorrow, not Monday, next week, right? Because there's premium, there's extrinsic value, there's theta still. But if we are at 260 at expiration, what's the value of that short option that we sold going to be? S&P is now approaching their highs of the day here, but not real busy. It was busy earlier when I was down here, not so much right now. Okay, yes, Zippo, right? Closer we get to our short strike and the closer we get to expiration, what happens? That extrinsic value, that theta just accelerates and we get close to zero. So, in a position like this, if we break this down, okay, and for those of you who are on the beginner side of things or maybe just starting, this is the way you look at it. Don't get overwhelmed, confused, scared by the names of a position or by, oh my God, I can't have three different options on. Okay. What do we have here in this butterfly? If we break it down to its, I'll call it its least common denominator. Okay. We are long this call spread, right? We own one 252.5 call and we've sold a 260. But in our position, we've sold two of the 260s. So we also have, in addition to the long spread, this. So we have a long, as Robert just said, we have a long and we have a short. We want, in a perfect world, we want the long part of our spread to get its max value. So where is that part of the spread in FedEx? Where will just the long part, just the long part, this part, where will that max out? Back in the day, by the way, if I was doing this and a floor official saw me, that would be a $250 fine. Okay, 260 or what? What if stock's 270 just on the long side, just on the circled part? What if it's 270, 280, 300? What's going to happen? That's right. It's not going to be worth more than that. It can only be worth 7.5, right? It can only be worth $250 fine, Paul, having a beverage or food if you got caught with it. Okay. Now, 260 or above at expiration, this thing is going to max its value at 7.5, right? Whether the stock is 260, 261, 280, 500, doesn't matter. That thing is going to be maxed out at 750. Now, let's look at the second part of the position we have, the other part of the spread. I'm being reminded here to put the word of the day up. So hang on one second, guys. Before we go into the second part of the day, hang on. The word of the day. There we go. Get your dartboards out. Get your dartboards out, everybody. Hulkster says bullseye. And those of you who have been waiting, because I said it may have been a couple weeks ago, week and a half ago, I don't know, whatever it was. We said we were waiting for a shipment of new gear to come in. Actually, it's supposed to be delivered today. So those in the queue to get that new gear, that'll be heading out to you shortly. Okay, back to our FedEx. Okay, we have a 252 and a half 260 call spread that we own, and we have a 260 262 and a half call spread that we sold. Okay, we already talked about this part. Now, where does the stock need to be at expiration for this part to max our profit out on just that part of the spread? Not the entire position, just the short part of the spread. If we want to max that part out, where does that have to be? Or what? 260 or what? Just push them over. Yeah, he actually he is. Actually he is, and Mike, I was a little, as us Jewish people would say, verklempt before because I couldn't figure out which speaker I was on. So anyway, sorry guys. Okay, so 260 or lower, and that part maxes out, which means if we want to have this part max out and this part max out, there's only one spot. There's only one spot where both can max out at the same time. Right? And that's at 260. That's our short strike. That's our short strike. Not that we wouldn't have a nice profit if it was 258 or 262, whatever, but the max profit would be right at the short strike for those of you in our short strike club. Does everybody understand that now? I just wanted to break down. It's obviously real easy in just a simple vertical spread to say, okay, if we get past the short strike, great, we've made our money. But on a butterfly iron condor combination here, this is why the answer always is the short strike. Because again, the part of the position that we own maxes out, while the part of the position that we have sold is worthless. There's only one spot that can happen. That is at the short strike. And again, How do we determine the short strike? It's not just closing our eyes or using the magic eight ball, or maybe the magic eight ball has a better percentage than the Black Scholes option pricing model of 68%. Who knows? But how do we do that? We use the expected move to guide us. Okay. Any questions? Any questions on why the short strike? And again, does not mean that we won't be profitable if it's not at the short strike. We absolutely still can be profitable and nice profits, but the max is there. All right. Any questions, anybody? Any questions at all? All right. With that, I think it's time to go to the wheel. Let's do it. Where do we get the info? Okay, Sanaz, hang on. Before we go to the wheel, let me answer this. A, there's no stupid question. Okay, there is absolutely no stupid question. Bobby, I'll get to that in a moment. How do we get to the expected move? Well, in the case of FedEx here, since we're using February 21st options, we look at what Robert just said, the at the money straddle. So in this case, the at the monies were the 250 strike call and put. We add those together, boom, 10 and a half bucks or so. There you go. Okay, it's literally that simple. Okay, does that help you out, Sanaz? And it is plus or minus. Yeah, if we were bearish in FedEx here, instead of targeting, that 260 area, we would target the 240 area if we were bearish. So to be profitable, Bobby, how do we know where we would be profitable on this trade? Okay, if this is our position, how do we know where we would be profitable at expiration? Okay, above the break even. How do we know what the break even? We got to know what we paid for it, right? We got if we paid $1 for it, then we'd be profitable above 251. If we paid $2 for it, excuse me, not 251, 253 and a half. If we paid $2 for it, we'd start being profitable 254 and a half or higher. Right? So it's our first long option, which in this case is the 252 and a half call, plus the debit or plus what we paid for it. That gives us our break even. Anything above that, we're going to make money. All right. Wheel time. Every time I say that, I know I always kind of go back to these really irrelevant things in the past, but every time I say wheel time, it reminds me of where's my wheel, Mike? It's there. I was taking a while to populate. There we go. Okay, wheel looks a little light today. Wheel definitely looks a little light today. Okay, here we go, guys. Here we go. And the winner is Gilbert or Harris. It is in the house? Gilbert, are you in the house? Let us know, Gilbert. Bingo. That was quick response. You were ready to type that in. All right. You know the drill. Think. You know the drill. Shoot me an email. Oh, there we go. Mike just put it up on the board. ProsperSwag at prospertrading.com. Thank you, thank you, thank you, everybody. Appreciate you tuning in. Have a wonderful rest of the hump day today, Geico Camel Day. We'll see you tomorrow.